Today, we're talking about everyone's favorite shaggy-haired former crypto bro and multi-billionaire, and now federal convict serving 25 years in the Metropolitan Detention Center in Brooklyn. It is, of course, Sam Bankman-Fried. We're not going to spend our time raking over the explosive growth and even quicker implosion of FTX. There are numerous fantastic videos on here which go into great detail about that. Instead, we're looking at one of Bankman-Fried's most famous trades, his arbitrage of Bitcoin in the South Korean and Japanese markets, starting in 2017, which are estimated to have netted Sam a staggering $20 million in just 3 weeks. That's assuming you believe all of the stories. We'll get to that in a little while. As a brief recap, Sam Bankman-Fried was born on the 6th of March 1992 in Stanford. He grew up in an academic family. His parents, Barbara Fried and Joseph Bankman, are both professors at Stanford Law School. Growing up, Bankman-Fried showed an aptitude for maths and science and attended Crystal Springs Upland School in California, known for its rigorous academic programs. He went on to study at the Massachusetts Institute of Technology, where he majored in physics and minored in mathematics. After graduating MIT in 2014, Bankman-Fried joined Jane Street Capital, a proprietary trading firm, as an intern at their offices in New York. Jane Street, known for its quantitative, data-driven approach to trading, trades across various asset classes and is known for its market-making operations and arbitrage strategies. Its approach appealed to Bankman-Fried because of its analytical rigor and reliance on mathematical modeling and probability, all of which aligned with his academic background and interests. At Jane Street, Bankman-Fried initially focused on learning the basics of quantitative trading and market dynamics. He gained hands-on experience with complex trading algorithms, financial modeling, and risk management techniques. Jane Street's emphasis on mathematical strategies helped him hone his skills in creating and testing trading models. It was also here that he was introduced to the concept of risk-neutral trading, where traders aim to make profits by minimizing exposure to market risk. This philosophy would later influence his approach to managing funds and making trading decisions. Bankman-Fried's role at Jane Street involved trading international exchange-traded funds. ETFs are baskets of securities that are traded on stock exchanges, and they often exhibit price discrepancies across different markets. Bankman-Fried's job was to identify these discrepancies and execute trades that could profit from them, essentially an arbitrage strategy. By doing so, he learned about the intricacies of cross-border and cross-asset trading, including currency hedging, transaction fees, and regulatory considerations. His time working with ETFs gave him a strong foundation in identifying inefficiencies in markets and how best to capitalize on them. By 2017, Bankman-Fried had spent 3 years at Jane Street, had been promoted to a full-time trader, and gained invaluable experience in quantitative trading, risk management, and market making. Although he was successful at Jane Street, he decided to leave the firm to pursue opportunities in the emerging cryptocurrency market. The decision was driven, in large part, by his desire to maximize his earnings potential. His goal was to leverage his trading skills to capitalize on the volatility and inefficiencies in crypto markets, which he saw as a way to earn to give on a much larger scale. Sam Bankman-Fried, partnering with Tara Mac-Ole, founded Alameda Research in late 2017 as a quantitative trading firm specializing in cryptocurrency. Bankman-Fried was the controlling shareholder and maintained control of Alameda's strategic direction. At the time, crypto markets were relatively young and volatile, with frequent inefficiencies and pricing discrepancies across different exchanges. This provided a fertile environment for arbitrage strategies, which he had experience with from his work in ETFs at Jane Street. The most famous of all of the trades which Alameda Research executed was a Bitcoin arbitrage, which focused on the price discrepancies of Bitcoin across regions. At the time, crypto exchanges in Asia often listed Bitcoin at a higher price than Western exchanges due to high demand and limited capital flow, a phenomenon sometimes referred to as the Kimchi Premium in South Korea and Japan. The Kimchi Premium emerged around 2016, had several notable peaks before it gradually diminished. It first emerged alongside Korea and Japan's interest in cryptocurrency, and in line with their enthusiasm to exchange their yen or won to buy Bitcoin, the price of Bitcoin would regularly be 10% higher on Asian exchanges compared to their global counterparts. When the crypto bull run of 2017 started to get into full swing, it wasn't unusual to see the premium to reach as high as 50%. During this period in 2017 and 2018, the popularity of crypto exploded in Asian markets, creating liquidity strains on exchanges, and which resulted in this pricing mismatch. However, post the 2018 bull run, regulatory changes in the Asian markets, which increased competition and impose a framework on crypto platforms, including enhanced due diligence checks, reduced the premium to below 5% until it all but vanished by 2019. The basic premise of the Alameda trade was perfectly simple. The first step was to buy Bitcoin on a US exchange, where the price was lower. Second, you transfer those Bitcoins to an exchange in Asia, where the market price was higher. The third step was to sell the Bitcoin for cash, which would typically be South Korean won or Japanese yen. Finally, you convert this cash back to US dollars and transfer the funds back to a US bank account. Because the Kimchi Premium persisted for a period of years, it was possible for Alameda to move millions of dollars a day, every day, through this trade to reap significant returns on capital. It all sounds perfectly simple, and you're probably kicking yourself for not taking advantage of the opportunity to generate your own million-dollar fortune. You could possibly even have linked it to the Japanese yen carry trade, which we discussed in an earlier video, and to which I'll provide a link in the description below. However, when something sounds too good to be true, it often is. Executing these arbitrage trades wasn't as straightforward as it seemed. Alameda faced a number of logistical challenges, especially with transferring money across borders. The primary difficulty in moving cash, particularly large sums of cash, across international borders is the imposition of government-imposed currency restrictions. South Korea has strict capital controls which limit the movement of large sums of money in and out of the country. These restrictions are designed to stabilize the Korean won and prevent excessive capital flight. However, for Alameda's arbitrage strategy, these restrictions meant there were limits on how much capital could be moved back into US dollars. South Korean regulations also required financial institutions to monitor and report large transactions, which can be flagged for additional scrutiny, which was a regular occurrence for an upstart American fund funneling millions in Bitcoin through the financial system in 2018. This made it difficult to transfer profits out of the country without regulatory oversight. Japan's capital controls were generally less restrictive than South Korea's. While Japanese authorities monitored large transactions, they did not have as stringent limits on transferring money in and out of the country. However, this did not entirely eliminate capital control barriers, as large sums of money could still trigger regulatory scrutiny. The second constraint was finding and developing suitable banking partnerships. In order to efficiently transfer funds across international borders, it is necessary to establish good banking relationships, which in 2018 it was difficult enough in the USA when it came to trading in Bitcoin, and even more so for a new US fund trading such assets in Asia. Banks were wary of the high volatility and perceived risks associated with crypto, as well as the regulatory complexities of such transactions. Converting profits from Korean won back into US dollars was not only subject to exchange rate fluctuations, which could be hedged, but also incurred high conversion fees, which could not be hedged. These fees could eat into the profit margin, especially as Alameda scaled their trade size. Managing these fees required careful planning, hedging, and sometimes leveraging forward contracts or futures to lock in favorable exchange rates. The third difficulty, not surprisingly, was regulatory and compliance risk. Regulations in South Korea required stringent KYC and AML compliance, which included monitoring transactions and reporting any suspicious activities. Alameda had to carefully manage these compliance requirements to avoid legal issues while handling high-volume transactions across borders. If Alameda or its partners moved funds in ways that regulators deemed improper or excessive, they risked fines or restrictions. Navigating these regulatory waters required them to work closely with legal advisors and ensure every transaction aligned with evolving regulatory guidelines in each country. The fourth difficulty was volatility, principally price fluctuations, which were not, and still are not, uncommon with cryptocurrency assets. This meant that even slight delays in transferring funds could expose Alameda to price swings that could erode arbitrage profits. For example, if Bitcoin's price dropped in Asia before they completed a transfer, the profit margin could diminish or disappear entirely. And in 2018, it wasn't possible to hedge the price of Bitcoin. Besides crypto volatility, exchange rates between the Japanese yen and Korean won and the US dollar could fluctuate, adding an additional layer of risk. Whilst this risk could be hedged, it was expensive when routing millions of dollars through the system each day. A final difficulty, particularly for a focused fund, was the scalability of the trade. The larger the trade volume, the more complex the logistics became. Capital controls, withdrawal limits, and transfer times could all act as bottlenecks, limiting the scale Alameda could reach without incurring additional costs or risks. To scale the operation efficiently, it had to diversify across multiple banks, exchanges, and partners, adding to the operational complexity. To compound these execution difficulties, Alameda also incurred not insignificant costs, which ate into the expected profits from the trade. The transaction fees were significant. Every trade on a cryptocurrency exchange incurs fees, typically a percentage of the transaction. In the Kimchi Premium trade, Alameda would face fees for both buying Bitcoin on US exchanges and selling it on South Korean or Japanese exchanges. For high-frequency trades, these fees could add up quickly. In addition to trading fees, exchanges charge fees for withdrawing or depositing cryptocurrencies, especially large amounts of Bitcoin. These fees could vary by exchange, and higher fees would significantly impact profitability for high-volume transfers. Once Bitcoin was converted to local currency, the Korean won or Japanese yen, withdrawing fiat currency from the exchange could also incur fees. Second, Alameda faced daily foreign exchange costs. Converting Korean won or Japanese yen into US dollars involved exchange rate spreads and service fees, particularly when moving large sums. Banks and currency exchange services often charge a percentage of the total conversion amount, meaning substantial costs for high-volume trade. Additionally, where futures contracts were used to lock in an agreed rate of exchange, additional costs were payable to the counterparties. Third, came the banking fees. Transferring fiat currency from a South Korean or Japanese bank to a US bank involved international wire transfer fees. Given the large volumes needed for arbitrage, these transfer costs could become significant, particularly if multiple transfers were required to avoid daily caps. If Alameda's funds were transferred through intermediary banks, which is common in international transfers, additional fees could be applied by these banks. These fees vary by bank and are typically charged as a percentage or a flat fee per transaction. Fourth comes regulatory and compliance costs. To meet regulatory requirements in each country, Alameda had to invest in compliance measures, such as anti-money laundering programs and Know Your Customer checks. Compliance-related expenses included hiring staff with regulatory expertise, implementing software for monitoring transactions, and legal fees to navigate the complex regulatory environment. For large transactions, especially cross-border ones, Alameda will have incurred filing and reporting fees. Compliance with local regulations required reporting large trades to financial regulators, which involved legal and administrative costs. Finally, we have to consider market liquidity impact costs created by Alameda. When moving large volumes of Bitcoin, the order could impact the market price, causing slippage, that is the difference between the expected price of a trade and the actual price executed. To minimize slippage, Alameda had to break up orders or strategically time trades, but doing so increased execution complexity and timing risks. If there was limited liquidity on South Korean or Japanese exchanges, Alameda may have had to pay a higher price to sell large amounts of Bitcoin quickly. And this was a trade where speed was of the essence. This liquidity premium, especially during high demand periods, could reduce arbitrage profitability. So we can see, despite the apparently huge profits of 50% on offer during the bull run of 2017 and 2018, there were significant costs associated with the trade, in addition to all of the other logistical difficulties. A lingering question, therefore, is whether Alameda ever actually made the profits it claimed on this Bitcoin arbitrage trade. Whilst the fund was no doubt aware of the trade, and probably even attempted to profit from it, given the costs and regulatory difficulties inherent in the trade, a persistent question remains whether Bankman-Fried exaggerated his involvement and success in generating outsized profits. Even Bankman-Fried himself acknowledged in an interview with RealVision in 2021, which I'll link in the description below, that the trade had many complexities. In this interview, he also acknowledged lying to banks in Japan to be able to move funds around, and that Alameda Research got its name in a bid to trick Japanese banks and authorities into believing it was a research institution in the USA. What do you think? Was this a beautiful trade that was inherently impossible to execute, or did Bankman-Fried actually manage to exploit one of the best arbitrages of the century and make millions from his efforts? If you've stuck with me this long, then a big thank you. I hope you found the video interesting, and I hope you'll join me for more of the same next time. Thank you.